If you're thinking about starting an LLC, stop right there, because most people skip 5 crucial steps before setting one up, and those mistakes end up costing them thousands of dollars every single year. I've seen it happen over and over again, and today, I'm going to make sure it doesn't happen to you. Stay with me because the last mistake on this list is the one that catches nearly every new business owner off guard. Let's start with mistake number 1, which is not understanding what type of income your business is actually going to generate. This matters more than most people realize because it directly affects which business structure makes the most sense for you. There are 3 categories of income you need to know about. First is ordinary income, which is money you earn by actively working. Second is passive income, which is money that comes in without you directly trading time for it, like rental properties or interest from savings. Third is portfolio income, which comes from selling capital assets like investment properties. Here's why this distinction is so important. If your income is passive, like from rental real estate, you're not subject to self-employment tax, which covers Social Security and Medicare. That changes the entire equation when deciding between an LLC, an S corporation, or a C corporation. Real estate investors often stick with LLCs for exactly this reason. But if your income is ordinary, meaning you're actively working in the business, you're looking at self-employment tax on top of federal and state taxes. Some people convince themselves their online business is passive because it feels automated. But if you put in the labor to build it, the IRS sees it as ordinary income. Mistake number 2 is buying real estate before setting up your LLC. This is one of the most expensive sequencing errors a new investor can make. Ideally, you want the LLC established before you purchase an investment property, so the property goes directly into the LLC's name. That gives you both liability protection and privacy, since your name won't appear publicly as the property owner. When people try to transfer a property into an LLC after the fact, they run into something called the due on sale clause. This is a provision in many mortgage agreements that allows the lender to demand full repayment if ownership of the property is transferred. Beyond that, getting a brand new LLC approved for financing takes time. Lenders want to see income history and credit established under that business entity, so planning ahead is everything. Mistake number 3 is setting up your LLC and then never actually using the EIN number. Your EIN is essentially the Social Security number for your business. If you're not running your income and expenses through a dedicated business bank account tied to that EIN, you're undermining the entire point of having the LLC in the first place. Lenders and financial institutions need to see a track record of business activity before they'll extend credit or approve loans. Without that paper trail, you simply don't qualify. This became brutally obvious during the pandemic, when many small business owners couldn't access relief loans because they had no verifiable business banking history. Don't let that be you. These forms are fundamental, and skipping them creates real problems come tax season. Nobody tells you this up front, and most accountants won't walk you through it unless you specifically ask. Here's a quick breakdown. If you're a single-member LLC or sole proprietor, you'll report income and expenses on a Schedule C, which gets filed with your personal 1040 return. If you have a multi-member LLC, meaning a business partner or even a spouse, you're now a partnership, and you'll file a 1065 return. Each partner then receives a K-1 form that flows into their personal tax return. The business itself doesn't pay taxes. The partners do at their individual rates. You'll also need to know about the SS-4 form, which is how you apply for your EIN number, and the W-9 form, which you collect from any contractor you pay more than $600 in a year before issuing them a 1099. Mistake number 5 is not knowing how to properly reimburse yourself when you accidentally pay for business expenses with personal funds. It happens all the time. You leave your business card at home and end up putting a work expense on your personal account. The solution is something called an accountable plan. This is a documented system that lets you formally reimburse yourself for those personal expenditures that should count as business deductions. If it's done correctly, those expenses still qualify as deductions and your records stay clean. Without it, You could be missing out on significant write-offs without even realizing it. So there you have it. Know your income type, set up your LLC before buying real estate, actually use your EIN, learn your tax forms, and build an accountable plan. These 5 steps separate business owners who thrive from those who get buried in avoidable problems. Hit subscribe if you want more content like this, and I'll see you in the next one.